Would you like to make more money and pay less tax? Of course you would, who wouldn't? Today I'm going to share with you some really good strategies where you can keep hold of more of the money that you're making and not paying it in tax. Before I get stuck into that, I need to make it clear I'm not an accountant, so make sure you get your own specialist advice. But let's get stuck in today's video and I'm going to share with you some top tips on how you can keep more of your money that you're making. So let's start off with the tax bandings. So up to your first £12,570, you get a personal allowance and you pay 0% tax. The next banding is basic rate taxpayer, and that the threshold is between £12,571 and £50,270, and you're going to pay 20% tax. The next one is higher rate tax. The threshold is between £50,271 and £150,000, and that is the banding that most of our clients, our investors that we're helping build portfolios for, are sitting. So they're paying 40% tax, and it's a heck of a lot of tax to be paying. And furthermore, if you're an additional rate taxpayer and you earn over 150,000, you're going to pay 45% in tax. So I'm going to share with you some tips on how you can reduce that and keep more of this money that you're making, because it's pointless making lots of money. Once you start making over £50,271, you're going to be paying 40%. It doubles from the basic rate. You don't want to be paying that money. So I've worked with my accountant to try and bring down my income coming to me, and I still sit within the higher rate tax banding, but we're trying to keep it as low as possible to that figure. So I only pay a little bit into the higher rate, and the rest of it I do some of these strategies that I'm going to share with you today. So let's suppose you're a basic rate taxpayer, so you're paying 20% basic rate taxpayer, and some people plan on staying as a basic rate taxpayer. They've got no desire to go above 50,000 in income, and that's fine, there's nothing wrong with that. And if you want to do that, then and you start a property business, there are some benefits. You can get much better mortgage products in your personal name as opposed to a company, so you won't pay as much interest. And you can also make use of your personal allowance to offset against capital gains tax. So if you sell a property and there's a gain, then you can use your personal allowance. This is some of the things you can't do with a company, but you'll see there's only two real benefits to having properties in your personal name. And when I show you the next part, where most of the high rate taxpayers are, this is where it gets really exciting and some of the benefits you get by utilising a limited company here in the UK. But if you are a basic rate taxpayer and you plan on staying as a basic rate taxpayer, then maybe buying buy-to-let in your personal name is a smart thing to do, so speak to your accountant. Now let's suppose you're like most of our investors, and like us, you're making lots of money, but if you're not careful, you're going to be paying 40% or 45% tax. So how do you stop paying that amount of tax? You need to set up a tax efficient structure, and the structure is what's known as an SPV, a special purpose vehicle, a fancy name for a limited company. But by having a limited company here in the UK, it has massive benefits to having it, and having a limited company. And I'm going to share these with you today. So if you don't know what an SPV is, go and look it up. I've done some previous videos on what an SPV is, but you can hold all your properties in an SPV. It's a standalone structure away from yourself, and you can put it in an SPV, the properties, it's its own business, standalone business. Now the first benefit is clause 24. Now if you don't know what this is, Google it, but clause 24, holding a property in your personal name, many years ago you used to be able to offset the interest part of your mortgage against the rental income, meaning you're not paying as much tax, but that got scrapped, and it means holding properties personally, you no longer get that benefit. But by having an SPV structure, it's a business, and you're allowed to bypass that clause, and you're actually allowed to offset the interest part of your mortgage against your rental income, meaning you don't pay as much tax. In a company, you pay corporation tax on what's left after all these costs. So it's a really tax efficient structure, and it actually means you can remain more profitable. The second one is pension tax breaks. This is huge. So you can pay yourself a pension every single year out of your SPV, and it reduces your corporation tax because all this comes off your profit. So you can actually pay your pension and all these other benefits I'm going to share with you. And then what's left, you pay tax on. Where it's different when you're personally, you typically pay tax on what's on the top line, and what's left you kind of get after all the tax. But it's the opposite with a company. You pay all these, there's all these clever things you can do. You can pay into pensions, you can have your cars and stuff, and then whatever's left you pay tax on. So this is why I love SPVs and limited companies. The third one is company to company loans. So you can actually start to build up money in here, or you might have other companies. We work with a lot of IT contractors, and they lend monies from their IT businesses to their SPVs to start building their portfolio, because it doesn't touch you personally. If you do company to company, it avoids the nasty taxes like high rate tax banding and such like when it hits you personally. So company to company loans, really tax efficient method as well. EVs, electric vehicles, this is brilliant. So we've got an electric car, we put it all through our company, we can claim back all the lease amount. It's on a lease, a long-term company lease, and we just get the relief off it. So all that comes and gets paid off every single month. We pay the lease out of the company, and again, whatever's left at the end after paying all these costs, you know, we get our car paid for by the company through the profit, and whatever's left you pay tax on what's left at the bottom line, which is brilliant. And the tax that you're going to pay at the moment with corporation tax is 19%. So it's a really tax efficient way of doing it. So it's not 40% for your high rate tax, but you're not getting 40% tax, you're getting 19% corporation tax, but that's on what's left after you've paid your pension, after you've done your electric vehicle, you put that through there, after all your operating costs of your buy-to-let. But also the thing I like about SPVs, it's got a good legacy benefit. So if you've got children or partners or wives or whatever, you can put them on as shareholders, and you can put the shares into trust, you can do all kinds of wonderful things. But if you hold them personally, the liability or the mortgages stay with you, and it can cause problems for estate planning. So from a legacy perspective, SPVs and limited companies are a very good way to go. So let me remind you of some of the costs you can take off to reduce your tax liability. So your pension, you can pay the profits out of the company into pension. Your buy-to-let running costs, so clause 24 doesn't apply, so you can offset the interest part of your mortgage against your rental income. You can offset your letting agency costs, your repairs, your wear and tear, all that kind of stuff. Electric vehicles, you can put them through the company. And dividends and salary, that's a really good way as well. You can pay yourself your dividends and your salary. Now, if you've got a wife or partner, you can put them as shareholders, and you can actually share the dividend and salary allowance, which means you can extract even more money out the SPV without triggering the 40% tax. So you can, you know, my wife, she works part-time, and I can top up her with the company share structure. We can pull out dividends in her name as well to top it up right away and make use of her tax band. And it means that I'm not having to pull that out and pay 40% tax on that as well. So these are really clever and useful ways to make sure you're not paying more tax. So just to remind you, we're only going to pay 19% at the moment, 19% on what's left after you've paid all those things. So it's a fantastic structure and a great way to remain efficient and to keep hold of more of that money that you're making, because no one likes paying tax. And it's all great saying that you earn all this money personally, but when you actually net it down after all your costs and all your taxes come off, you actually don't make half as much money as you think. So you need to have these structures in place to make sure you're keeping hold of more of that money. I hope you've enjoyed this video. As usual, hit the like button and share button, and I'll speak to you on the next video.